A massive 10% of dividend, but down of about 10% since the beginning of the year. Is Labrador Iron Ore a great stock to watch at the moment or only a trap?
It's a trap!
Today, I'll be answering this question and I'll make a full stock analysis on LIF stock. As always, I will start by analyzing what is the business model of the company. So what are they doing and how are they able to generate their income? And after, I'll make a full fundamental analysis with a price prediction from different valuation methods, which will help me to see if the stock is currently under or overvalued at the moment. Let's get to it right now. Labrador Iron Ore, as his name is saying it, is acting into the mining sector, more precisely into the iron ore pellet market. In fact, this commodity company acting in the metal subsector is having many different great characteristics. The main particularity of this company is that it is a royalty business investing into the Iron Ore Company of Canada known as the IOC. And the IOC is a leader in North America in the production and in the exportation of iron ore pellets. On your side, what you can do is basically invest in Labrador Iron Ore on the TSX market with the ticker LIF.TO, and on their side they are an investor in the venture with Rio Tinto and Mitsubishi in the Iron Ore Company of Canada. And it's why LIF currently owns about 15% of IOC, and LIF currently has a 7% royalty on all the different sales of iron ore pellet from IOC. But for the term of the video, to not confuse you, when I'll be using the term Labrador Iron Ore, I'll be also implying that it is talking about IOC. So this Canadian business has been producing and processing iron ore from their different facilities, which are actually located in Labrador City, Labrador, and Newfoundland since 1962. The process behind it is quite simple. First, the iron is extracted and concentrated in different iron ore pellets in their mine facilities. After, the finished products are transported by rail lines to their main port of Sept-Îles in Quebec, and from there, all of those products will be shipped by boats to numerous markets all around the world. And just to give you a great overview of the company, per year on average, they are exporting about 20.9 million tons of iron ore pellets all around the world by different vessels. And on average, those boats are transporting about 25,000 to 250,000 tons of iron ore pellets on their board. And for those that wouldn't know, about 98% of the total production of iron ore pellets is converted into steel. And this steel can be used for the transportation, the construction, the energy infrastructure, and the household appliance. But also buildings, bridge, and other infrastructure are built straight from those iron ore pellets. So as you can understand, this is a pretty essential resource for us. Over the last couple of years, LIF has had its high and its low, but it's still currently worth about $2 billion at the moment. And in 2021, they have reported some revenue of close to $300 million. But as I just told you, the valuation of this company has fluctuated a lot in the past couple of years, where it has had some great positive momentum at the beginning of the pandemic before to lose some when we reached the month of March 2022. But since the end of the summer, we can see that it has regained some positive momentum. However, one of the main reasons why this company has lost so much value over the last couple of months is that it is really mainly depending on the iron ore market. Since the iron ore market is a cyclical market where the prices will fluctuate depending on the cycle, well, we can see that we were not necessarily in a great cycle over the last couple of months because of the diminution and the decline in the Chinese property market. Currently, China represents over 50% of the global production of steel, and it also represents over 70% of the iron ore demand. But even if the steel production in China remained strong at the beginning of the pandemic, the Chinese government has recently curbed the production of steel to lower the input price, which has obviously had a direct impact on the price of iron ore. In fact, at its peak in 2021, this material worth over $200 billion, and now it's worth less than $100. So only in about 1 year, they have lost over 50% of their total value. And as a great commodity company, as I told you earlier, it acts as a cycle because people will sometimes have bigger needs for this kind of materials. But of course, sometimes this demand will obviously be lower. But an excellent news about this company is the incredible dividends that they are giving to their different shareholders. In fact, over the last couple of years, we've seen that they were giving some special dividends. So even if they are not a company that has been increasing their dividends since more than 100 years like some big banks in Canada, well, they are still rewarding the shareholders with some special dividends. Those special dividends are usually some one-time payment that are made to the shareholders that have bought the company. They are usually given in the form of cash, and often it comes from the fact that the company has had some unexpected strong earnings. Unfortunately for the LIF investors, we can see that over the last year, they haven't been able to beat what were the prediction of the analysts for the different earnings, which has led them to not give any kind of special dividend over that last year. But another great point about this company is that they are trying and that they are focusing in keeping the company debt-free. So obviously they don't have to face the different hike of the interest rate, which is a pretty good news for the investors, but also for the board of manager. But now, let's see if it is worth your money. In terms of valuation, we can see that this company currently worth a pretty low $2 billion at the moment. However, with a super low price to earning ratio of only 7, meaning that on that side, this stock would be currently undervalued. After, what we can notice is that they have had some incredible profit margin of higher than 122%, with also an incredible great operating margin on the last 12 months of about 76%, with some great return on assets and some great return on equity. Over the last 12 months, we can see that this company has returned about $244 million of revenue. Unfortunately, as I told you earlier, they've had some pretty bad earnings over the last 12 months, as we can see with their quarterly revenue growth diminution of about less 15% and their diminution in their quarterly earnings growth of about less 24% over the last quarter. And as mentioned earlier, this company is aiming to be a debt-free company, as we can see with the massive position of about $43 million in cash, compared to currently having no debt. For the risk of this company, which is represented by the beta on a 5 years period, which is basically showing the risk of a certain company versus the risk of the overall market, we can see that this company is currently more risky than the market with a beta of about 1.29. However, over the last year, we can see that they have only lost about less 10% compared to about less 15% for the overall market, and the dividend yield is predicted to be about 9.28% with a super great payout ratio of only about 76%, which is pretty good in that case since the dividend is pretty high. It means that it is still sustainable because, as I told you earlier, it is a lot based on the special dividends that are sometimes given to the different shareholders of this company. In terms of the revenue, we can see that over the last 3 years, they have been able to increase their total revenue, which has led them to receive some higher net income at the end of those 3 years. In terms of their cash flow, we can also see that they've been able to increase their cash flow over the last 3 years. Unfortunately, we can see that they have been diminishing a lot over the last 12 months, which have been reflect on their free cash flow evolution. And now, to find what is the right price of this company, I'll be using many different evaluation models to help me out with that. And I'll start with using the Peter Lynch valuation, which is basically using the future growth of the earnings per share that you add with the dividend yield and that you will come divide by the price to earning ratio. This always knowing the fact that when you multiply the price to earning ratio with the earnings per share, you will find what is the current price of the company. And with these information, we can see that the result is about 2.6, which would mean that this stock would be currently pretty close to being way undervalued at the moment. Now for the dividend discounted model, unfortunately we won't be able to use it in that case since the model don't work when the average growth rate of the company is higher than the weighted average cost of capital. And here we can see that the average growth rate of the dividend have been super high because obviously of the special dividends. But finally we'll be able to use what is the discounted cash flow model. So once again, the first step is to find what is your weighted average cost of capital, where you will come calculate the cost of debt, the cost of equity, and finally the cost of debt and equity to find what is your weighted average cost of capital. After, you will come annualize all the different free cash flow to find what is the enterprise value. You add all the different other criterias, and at the end of the day, you can find that the real and the intrinsic value of this company is about $109 at the moment, which would mean that this stock would be a massive buy at the moment on those terms, and that it is currently undervalued. As you've been able to see with this stock analysis of Labrador Iron Ore, this business is super interesting for investors that are looking for great companies that are offering some super high dividend income. However, if you decide to invest in that particular company, you obviously expose yourself to some cyclical risk, since this company is mainly driven by the iron ore market that is on its part driven by the Chinese market. If you decide to invest in LIF, you will have an indirect impact from the Chinese economy. But despite having some bad momentum over the last couple of months, we can see that this company in fundamental terms is pretty solid, and it's why this company would currently be undervalued on that side. And personally, this kind of encouraged myself to start a position in that particular company. But on your side, if you want to see what my stock portfolio looks like, make sure to check out the video that's gonna appear right over here. And for everyone that likes personal finance, make sure to join the North family by subscribing to the channel for only $0.0, and I will see you soon. Peace!